Welcome to the Pro Ticker Deep Dive. Today we are diving headfirst, really, into one of the most, let's say, mathematically tricky corners of the market right now, real estate investment trusts, REITs.
Yeah, it's a sector that's really sitting at a point of maximum tension, you could say.
Definitely. You've got the situation where some investors see maybe a generational bargain, while others are looking at it thinking this looks like a slow-motion disaster unfolding.
The anxiety is palpable.
Yeah.
If you just look at the surface, the appeal is obvious.
The yield, right.
Exactly. REITs are offering yields around 4%. And when you compare that to the S&P 500, which is, maybe 1.5%, that 4% really stands out for income investors.
It's a huge difference, yeah. A powerful magnet. But, okay, here's the rub, the conflict. Even though the whole REIT market is trading at a discount, maybe at 12% below its net asset value, its NAV, there's this big growing worry.
A worry that those yields maybe aren't sustainable, that they lag behind the real cost of owning property today.
Precisely. It feels like a classic misalignment.
And that really creates a fundamental question for you, the investor. Are you getting a great discount on something about to bounce back?
Or are you stepping into, well, a hidden trap?
Yeah.
So our mission today is to unpack this mathematical tension. We want to figure out if investors jumping into REITs now are getting a bargain or just chasing a yield the market can't actually support long term.
Let's dig in. And maybe the place to start is the root cause, this yield lag paradox.
Okay.
What's really interesting here is that there probably isn't like fundamental demand for real estate itself. It really traces back to an external shock.
The Fed.
The Fed. Their aggressive rate hikes starting back in 2022. I mean, it was the most disruptive hiking cycle in, 40 years?
It was massive. But why REITs specifically? Why did it hit them harder than maybe other sectors that also use debt?
Well, it's kind of a double whammy. It's the debt, yes, but also their legal structure. Think about the 10-year Treasury yield. It climbed incredibly fast. It was around 1.5% in early 2021.
All right. Yeah, feels like a lifetime ago.
Right. And by January 2025, it hit 4.79%. That kind of shock hits REITs really hard because, one, they rely heavily on cheap leverage to buy properties.
Okay.
And two, legally, they have to distribute at least 90% of their taxable income every year.
90%. That's huge.
It is. So when your borrowing costs suddenly skyrocket, that mandatory distribution puts immediate stress on their cash flow, their ability to reinvest, everything.
That makes sense. So the market's punishing the balance sheet, the structure, maybe more than the actual day-to-day operations.
In many cases, yes. Which brings us to the core metric to really get this paradox, the cap rate.
Right, the cap rate. Can you break that down? What's the fundamental relationship there that's under so much pressure?
Sure. The cap rate, or capitalization rate, is basically the property's expected rate of return if you bought it all cash, no debt involved. You calculate it by taking the property's net annual income and dividing it by its current market value. The real problem lies in the spread between that cap rate and the risk-free rate, which we usually proxy with the 10-year Treasury yield.
And what do those numbers look like right now, that spread?
Well, current implied cap rates on average REIT portfolios are hovering around 5.9%.
5.9, okay.
Meanwhile, the 10-year Treasury is, let's say, near 3.9%.
So quick math. That's just 200 basis points, 2%.
Exactly. A 200 basis point risk premium.
Wow. That feels incredibly thin. Is that normal?
Not at all. Historically, that spread the cushion investors demanded for taking on the risk of owning actual property, illiquidity, operational stuff, that usually ran between 250 and maybe 500 basis points.
So 2.5 to 5% historically, now just 2.
Yeah. The fact that investors are accepting this historically low premium essentially means they're making a big bet.
Betting on what? Rates coming down fast.
Either that the Fed has to cut rates soon, or that property income growth is going to accelerate dramatically to make up for it. They're sort of walking a tightrope without much of a safety net right now.
And we've already seen the damage this tension, this thin spread has caused in performance. Can you walk us through that slow motion repricing effect?
Yeah, it wasn't like a sudden crash. It was more like a slow bleed, driven purely by the math of valuation.
Okay.
Imagine you bought an office building, let's say, when the market was happy with a 5% cap rate. Maybe it was valued at $8 million.
Right.
Now, rates rise, and the market demands a higher return, say a 6.5% cap rate, for that same building with the same tenants, same income.
Just because the cost of money went up.
Exactly. Instantly, that property's market value drops, maybe down to, say, $7.7 million. And this happens before any rent changes, before occupancy drops. It's just the math.
Wow.
And that repricing effect is why the overall REIT sector delivered that negative 1.7% year-to-date return through September 2025. It trailed the S&P 500 by over 1,100 basis points.
1,100 basis points. That's a staggering underperformance. But is that pain spread evenly across all types of REITs? Or is using the single term REIT kind of hiding a bigger story?
That is absolutely the critical point here. It's not a uniform bubble, not at all. We're seeing severe bifurcation.
Bifurcation. Okay.
Relying on just REIT as a category is dangerously misleading right now. It really masks this deep fragmentation between different property types.
So let's split it. Let's start with the bad news. The languishing legacy assets. Where's the pain most acute?
Office REITs. That's the absolute epicenter of the trouble.
No surprise there, I guess.
Yeah, they're languishing. Discounts to NAV are exceeding 50%. And in some specific troubled office trusts, you're seeing 70% discounts.
70% below the supposed value of the buildings. That sounds like fire sale territory.
It practically is. And the reason it's structural, it's deep, remote work, hybrid work. It seems to have really calcified into permanent corporate culture.
Right.
That pushed the nationwide office vacancy rate up to 20.6% by mid-2025. And it's particularly bad for the Class B and C properties, the older buildings, maybe not in prime locations.
Especially in certain cities.
Exactly.
Yeah.
Secondary cities. Think Pittsburgh, Cleveland, Dallas. Those B and C properties have almost devolved into what some analysts are calling dark matter.
Dark matter. That sounds bad.
It implies assets that are barely trading, maybe only at auction-like prices. We're talking $100,000 per 1,000 square feet, maybe when they might have fetched $300,000 before. It's a huge drop.
Okay. And it's not just office, right? Other sectors struggling.
Retail and hotels have also definitely struggled. Hotels specifically plunged negative 13.6% year-to-date, so real pain there too.
Okay, so that's the dark matter, the problem areas. But on the flip side, you mentioned bifurcation. What's shining? You see things like data centers trading at huge premiums to NAV. Like 19% premium.
Exactly. That's the other side of the coin.
How do they manage that? How do they decouple from this whole rate crisis?
The winners here have these immense structural tailwinds. Forces so strong, they kind of override the rising cost of capital, for now at least.
Like AI for data centers.
Precisely. Data centers are trading at those 19% premiums. They gained almost 5% year-to-date. It's all powered by this relentless, almost insatiable demand for AI infrastructure.
And the market expects that to continue.
Oh, yeah. They're trading at like 24.6 times forward FFO multiples. That signals massive growth expectations baked in.
Okay, hold on, FFO. You mentioned that multiple. That's a key piece of REIT jargon. Can you quickly just remind us what funds from operations means and why it's the go-to metric here?
Absolutely. Good point. FFO, funds from operations, is the specific cash flow measure Wall Street uses for real estate. Traditional earnings, like net income, get really skewed for property companies because of huge depreciation charges.
Right. Depreciation isn't actual cash leaving the building?
Exactly. FFO basically adds back that depreciation and amortization and makes a few other adjustments to give you a much clearer picture of the actual cash generated by the properties that's available to, pay dividends or reinvest.
So if you hear FFO, or sometimes AFO, adjusted FFO, that's the number reflecting the real operating cash flow.
That's the one to watch.
Yes, got it. Okay, so data centers are trading high because the market sees huge FFO growth potential from AI. What about other winners?
Healthcare REITs. Incredibly robust. They were up almost 22% year-to-date.
Driven by demographics.
Clear demographic tailwinds. The aging population means more demand for senior housing, medical office buildings, life science labs. It's a very strong long-term trend.
Makes sense. Any others?
And industrial properties. The big warehouses, logistics hubs. Still very resilient, boosted by e-commerce needing efficient supply chains, and just a general scarcity of modern logistics space.
Okay, so this bifurcation is really stark, and it sounds like it confirms that the massive discounts on office aren't just about cap rates going up. It's the leverage, isn't it?
Leverage is the amplifier. Right. That's where the math gets truly catastrophic for the equity holders in those distressed sectors.
How so?
Well, if an asset was financed with a lot of debt, let's say 80% loan to value, so only 20% equity, even a modest decline in the property's value.
Which we saw happens just from cap rates expanding.
Right. Even a modest drop from, say, 5.9% to 6.5% cap rate assumptions, which doesn't sound enormous, that can absolutely crush the equity stake.
Wait, say that again? A small property value dip wipes out a huge chunk of the equity. How does that work?
Think simple numbers. You have a $100 property. You've financed it with $80 of debt, so you put in $20 of equity.
80/20.
Now, rates rise, cap rates expand, and the property value dips just a little, maybe to $95. That's only a 5% drop in total value.
Right.
But your debt is still $80. That's fixed. So what's left for the equity holder? $95 minus $80. Only $15.
So the $5 drop in property value came entirely out of the original $20 equity stake.
Exactly. That small $5 drop in total value translates to a 25% loss. $5 out of $20 for you, the equity holder. Our data suggests that in realistic scenarios with high leverage, even a modest property value decline can lead to a 47% haircut for the equity.
47%. Okay, that explains the 70% discounts to NAV then. It's not just risk. Leverage is acting like a weapon against the equity.
It absolutely is. Investors are pricing in that refinancing risk, the potential for forced sales, and the very real possibility that the equity claim could get completely wiped out on some of these properties.
Suddenly that deep discount looks less like a bargain and maybe more like the market pricing in potential liquidation for the equity holders.
That's the fear driving those low valuations.
Okay, let's pivot then. Given all this risk, the bifurcation, the leverage issues, what's the bull case? Why are some institutions apparently positioning for a recovery? What are they seeing?
Well, the bull case really centers on things stabilizing and maybe a reversion back to historical norms.
Okay, argument number one seems to be about dry powder.
Right? Institutional investors, big pensions, endowments, they typically have target allocations to real estate. Right now, data suggests they are, on average, about 90 basis points underallocated compared to those targets.
Meaning there's money sitting on the sidelines.
Significant pent-up capital, yeah. It's ready to be deployed once conditions seem a bit more stable, once the interest rate picture gets clearer. So the bulls see this current mess as a potential buying window, not necessarily a permanent impairment.
And they must be looking past the valuation multiples to the actual earnings, the FFO, which seems surprisingly okay.
That's the core contradiction, isn't it? The earnings growth, the FFO growth, is projected to be pretty solid. Analysts are forecasting around 6% FFO growth for 2025 and 2026.
6%, that's pretty decent. Comparable to the S&P 500, roughly.
Yeah, it's in the same ballpark as forecast for the broader market. So the question becomes, if the underlying earnings growth is solid, why is the valuation multiple so compressed?
That is the million-dollar question, or maybe trillion-dollar question for this sector. Why are investors only paying, 13.8 times forward FFO now, when historically it was more like 16 or 17 times?
The bulls would argue the market is over-discounting the risks. They believe many REITs will successfully navigate refinancing, maybe asset sales help, and that once the fear subsides, that multiple will expand back towards its historical average.
And if that happens, you get a double benefit, the FFO growth plus the multiple expansion.
Exactly. That's where the potential for significant returns from these currently discounted prices comes from.
Okay, what else are the bulls pointing to? Supply relief.
Particularly in office, the weakest link. New construction has slowed dramatically. It's at a 13-year low. Only about 13 million square feet expected in 2025.
Less new supply should help eventually stabilize rents, at least for the better properties.
That's the theory. It takes time, but it has put a floor under things long-term. And finally, the big one, rate stabilization.
The hope that the Fed is done, or close to done.
Pretty much. Market forecasts generally expect the 10-year Treasury to kind of stabilize around 4.1% through the end of 2025, and maybe, just maybe, drift a bit lower by mid-2026. If that happens, it could unlock that valuation expansion we talked about.
Okay, those are some compelling points for a recovery thesis. But let's bring in the bears. What are the concrete risks that could just completely derail this?
The biggest, darkest shadow over the whole market is the maturity wall.
The debt coming due.
Yeah. Roughly $1.5 trillion in commercial real estate debt matures by the end of 2025.
1.5 trillion.
Wow. And many property owners who took out that debt when rates were near zero are now facing refinancing at rates maybe 200 to 300 basis points higher.
Ouch. That could turn a profitable property into a money loser overnight.
It absolutely can. It could force sales, defaults, restructurings. A lot of pain could still be coming down the pipeline from that maturity wall.
Okay, risk number one, the maturity wall. What else?
Risk number two is that fundamental yield compression we discussed earlier. The basic reason many people bought REITs reliable income higher than safe assets is kind of broken right now.
Because treasuries offer similar yields with zero risk.
Pretty much, you can get close to 4% on a risk-free treasury. Why take on all the leverage risk, vacancy risk, Refinancing risk of a REIT for a similar, maybe even slightly lower, yield like 3.9% on average.
So if rates stay elevated near 4%, the relative appeal for income investors just isn't there like it used to be.
It fades significantly. That's a major headwind.
And the third risk, maybe the most fundamental one, is that maybe the current discount isn't a mistake. Maybe it's justified.
Exactly. That's the value trap argument. What if the structural headwinds, like permanent remote work, really sticking? Or maybe AI automating away certain office jobs, what if those are real and lasting?
Then the current low valuations aren't an opportunity, they're just reality.
Correct. It would mean some of these REITs aren't actually undervalued, they're structurally impaired. Buying them cheap doesn't help if their earnings power is permanently lower. It's a classic value trap.
Okay, so bringing it all together, we've got the yield tension, the bifurcation, the bull case, the bear case. What's the final word for you, the listener, trying to navigate this? Bargain or trap?
I think the most likely outcome is that the bifurcation continues and maybe even gets more pronounced. The REIT market today feels less about underlying real estate fundamentals.
And more about balance sheets and Fed watching.
Exactly. It's about balance sheet strength, access to capital, and where interest rates go. Quality assets, your industrials, data centers, healthcare, they probably continue to command premiums and appreciate.
Well, the legacy stuff.
Legacy garbage, particularly the highly leveraged office properties, likely continues to deteriorate or face restructuring. And that big middle tier, they probably just tread water until we get real clarity on interest rates.
So don't expect the whole sector to move as one block. It's going to be very segmented.
Very segmented.
And for you, the listener, trying to make a call, the critical variable, the absolute fulcrum, seems to be the 10-year Treasury yield.
That's the number to watch. Our data suggests a potential threshold. If the 10-year yield declines decisively, let's say down to 3.5% by mid-2026,
Then REITs probably have a strong run.
likely outperform significantly, yeah.
Yeah.
Mostly due to that multiple expansion kicking in. But flip side, if the 10-year yield pushes above 4.5%,
Then the downside risks really accelerate.
significantly, that maturity wall becomes much harder, maybe impossible, for weaker players to climb. Refinancing failures would likely pick up.
Okay, so it really boils down to your view on rates and where you choose to place your bets within the sector.
Precisely.
And maybe a final thought for you to consider. For those looking at those really deep discounts, the 50, 60, 70% off NAV in distressed office, the potential reward is obviously huge if things turn around.
Huge upside.
But the recovery timeline is incredibly uncertain. So the central question you need to ask yourself is, are you truly buying a deeply discounted asset based on its current, maybe impaired cash flow? Or are you actually making a much bigger, riskier bet on a fundamental shift back in corporate culture regarding remote work?
That's the core gamble in that distressed space.
Something to definitely mull over. See you all in the next Pro Ticker Deep Dive.